Common Sense on Mutual Funds by John C. Bogle. The market always rises, but beware of individual managers. Welcome to YourBookSummary.com. Two major forces have impacted the performance of the American stock and bond markets. The first is the fundamental market, such as earnings, dividends, and yields. The second is speculation, trading based on opinions and emotions about the market. Investors trust their fund managers to make investments that generate positive returns. Their faith in the market has had its ups and downs, but on the whole, it has been remarkably durable, surviving the Roaring '20s, the depressed '30s, wars, bubbles, busts, and more. Investors' faith has often been well rewarded. Stock market investors have done better than bond investors. Although short-term investors may suffer because of market volatility, the volatility of stocks declines in the long term. In other words, the longer the holding period, the lower the volatility. Ironically, bond market returns are inconsistent compared to equities. Inflation is the biggest risk for the investor in U.S. government bonds, which carry no credit risk. In comparison, developing countries' corporate bonds carry substantial credit risks. However, while the stock market has favored investors, individual stock pickers do not fare as well as the overall market. Economists have demonstrated convincingly that stock managers have difficulty beating the market over the long term. Those who win against the market one year often lose against it the next. Moreover, investors who entrust their money to active, stock-picking managers usually pay dearly for dubious performance. Transaction costs also take a toll on investor returns. The most cost-effective approach to investing is to dispense with the active manager and buy a representative cross-section of the entire market. So-called passive investors never beat the market. But they never lag behind it either. Moreover, they pay lower management fees and expenses than investors who hire active managers. Consider this syllogism: the sum of active and passive gross returns equals the market's gross return. Active investors have higher costs than passive investors. Therefore, passive investors earn higher net returns. I hope you found the information about Common Sense on Mutual Funds by John C. Bogle. If you're interested in learning more about the book, stay tuned for the next part of this series where we'll dive into the next section. Thanks again for watching, and I will see you in the next video.